Good morning, ladies and gentlemen. Thank you for taking the time this morning to join us for what should be a fascinating insight into the hotel sector and its relationship with private equity. We have some exceptional speakers who no doubt bring this subject well into life over the next hour and a half. Private equity has changed and influenced the industry in quite a major way over the last two decades. Hotels responded particularly well, I think it's fair to say, to the challenges presented by the pandemic since 2020. And yet last year, we saw some encouraging signs of how it's returning to strength. However, the industry does still face many challenges, still in terms of costs, inflation, energy, staffing, all across the world. So how is this influencing investment opportunities? We ask, how does private equity still view the sector as we now look forward to, obviously, the rest of the decade? There are many good signs, too, as many countries now today possess developed, sophisticated plans for tourism growth, which will naturally attract investment. France alone has a plan to increase its numbers of tourism by over 25% by 2026. Investors are looking for an opportunity. So we ask, what is private equity's view of the hotel sector today? Last year, the view was that private equity had rediscovered its taste for hotels. And actually, the number of deal activity had naturally increased. Now, however, what's the long-term outlook now, and how does it look today? Certainly, investors are looking for strong data from the industry, plus focusing far more intently upon ESG strategies. And this has been one of the major changes in the last couple of years. Has this become a central piece of a jigsaw when it comes to investment? All questions to be answered over the next hour and a half. So firstly, let's just ask some poll questions of you, so we just get a feel for what's going on. Izzy, can I ask if you can bring up the poll questions? Now we have 3 questions, and you'll need to scroll down for the final one, I believe. Question 1, do you expect investment in hotels in the next 12 months to change in volume? By, and your answer, please. Which type of hotels will investors seek to acquire the most in the next 12 months? And that was interesting how that's changed over the last few years. And the final question, what main reason will discourage investors from acquiring or investing in hotels in the next 12 months? I'll be interested in your thoughts on that. Izzy, can we see the results? So do you expect investment in hotels in the next 12 months to change in volume? I think grow by 10% or more seems the 41% are answering that's the case, and 34% grow by 5%. That's interesting. Which type of hotels will investors seek to acquire the most in the next 12 months? City centre full service, 36%. Resort leisure, 41%. And I think that's one of the big changes we've seen in the last 18 months, isn't it? And what main reason will discourage investors from acquiring or investing in hotels in the next 12 months? 49%, the availability of debt finance, which is obviously one of the key discussions going around the industry at this moment in time. And 22% obviously concerned about rising inflation and operating costs. Thank you very much. Very interesting. Thank you for that. Please use the chat at the bottom of the screens to ask questions. Again, we'll try to make sure all your questions get answered, whether in this session or after the session. So if your question doesn't get asked during the session or answered during the session, then we will write to you and actually try to answer the question as well. So rest assured on that. But please feel free to use the chat and ask any questions as we go. And we hope you enjoy the rest of the session. First speaker, may I introduce Graham Smith, Managing Director of Alex Partners, to the screen. Good morning, Graham. I'll hand over to you. Good luck.
Thanks, Chris. Appreciate that. Welcome, everybody. Let me just share my screen. Great. Hopefully everybody can see that. So good morning, everybody. My name's Graham Smith. I'm a partner and managing director at Alex Partners. I specialise in providing corporate finance and restructuring advice across the travel, hospitality and leisure industry, and have worked a lot in the hotel sector over the last 10 to 12 years. So I'm going to provide a perspective on private equity in the hotel industry and more the background around that to feed into then Charles Human from HVS, who's going to continue that topic. So in my presentation today, what I'm going to cover is the backdrop in terms of the funds raised by private equity more generally and how that's feeding through into deal activity. Look at some of the key issues that private equity are considering in the sector right now, and also some of the positive considerations that are feeding into those decisions as well. Then look at a little comparison between the performance in equity values for the hotel industry relative to general real estate. Then I'm going to look at actually what lessons can we learn from how the market recovered from the credit crunch, the great financial crisis back in 2012 onwards, and what we might learn from that in terms of what will happen next over the next 12 to 18 months. So first of all, what it's clear when we look at the data, certainly across the US and also Europe in terms of the funds raised, we hear a lot about this dry powder. And we can see as we look at the chart here, which looks at funds raised initially across real estate, private equity, a very consistent level of capital being raised for investment. But then once you add on top of that, then the broader private equity industry, we can see that these are significant sums that have been raised consistently over the last 5 years, ready to be invested in the sector and the industry more broadly. What we also looked at is actually what's happened to the number of funds that are being raised by private equity. And of course, this is across the whole industry rather than simply hotels, but the fund count, so the number of funds that have been raising money has dropped in recent times, but the funds raised have remained broadly the same, which just goes to show the scale of funds is increasing. So predominance of the larger funds being successful, they're raising capital. And what we can see is this has absolutely flowed through into broad deal activity, again, across USA and Europe. And we can see as we recover from the pandemic, then actually there was this rush of M&A activity through 2021, which continued into 2022 once you take into account the forecast deals towards the end of the year. But what we would note from this is that actually within 2022, this was really a game of two halves, and we saw that activity really dropped off as we went into the second half of 2022, and this really being driven by the economic uncertainty which arose at that time. And we saw a number of triggers around that. So both from an operational perspective with increasing energy costs, the availability and cost of people, general inflation and the cost of living crisis. But of course, what's incredibly important for the hotel industry as an operational real estate sector is that the step up in the increase in cost of debt finance was significant and rapid over the second half of 2022. And also that fed through into actually just the simple availability of debt finance is there to support deals. So as we got towards the end of the year, what we really saw was in the second half, then deals that were getting completed were generally those which were well progressed already. And we saw this predominance of wait and see becoming almost, if you like, kind of accepted wisdom as we came towards the end of the year. What we also saw when we look at private equity and more of the hedge fund money, then it pivoted into more liquid investments, whether it's the public markets or traded credit, because that's where people could see really deep value in those trades, but also the ability with them being liquid to be able to trade in and out of those when the profit was realized. So if we go through to the position that we have today, there are a number of key issues that private equity are focused on, which are well known, but I think the continued high level of the energy costs that businesses are facing, we are seeing a reduction in the wholesale prices, but it's not feeding through quite as quickly into the cost that operators are having to pay in their energy bills, which remains at an elevated level. We're seeing that continued input cost inflation, both in operations, but I think also importantly in developments. So a lot of hotel developments based on assumptions which happened, developed pre-pandemic. I think they're now having to be readjusted in terms of the cost of development and the completion of those, and whether that still works from a returns perspective. Staffing continues to be a challenge. We've seen the increase in staff costs as the national minimum living wage increased again at the start of the new tax year. I think availability challenges have become less acute, but are still very difficult. We've also heard in the intro from Chris around the investment needs that are there in relation to ESG and the environmental regulations. So that's an increasing focus when looking at hotel projects. We talked about the cost of finance increasing, but also really the availability of executable deals, just general volumes, but also those which can be transacted where we get that matchup between buyer and seller price expectations. But I would point to a number of positive considerations that are really being experienced by the hotel industry, and particularly relative to broader real estate. So the yield management, the daily pricing of rooms that hotels are able to influence, we've absolutely seen that be a positive for the industry, as being able to deal with and offset the input cost inflation that is being felt. And the demand actually for travel, particularly leisure and also domestic corporate, has rebounded incredibly strongly. So hotels have been able to significantly increase rates. We're yet to see the full reopening of all the long haul routes, in particular China. So that's still to come in terms of potential increase of demand in the future. Also, given the disruption in the market, we see the ability for actually the strength in operations. So good managers being able to differentiate themselves in hotel performance because of the operational disruption that's being experienced. There is this need for investment to drive development, the ESG investment that's required, but also to invest in technology to keep pace with what customers are expecting. So from a private equity perspective, with the dry powder that's been raised that we've talked about already, I think that combines to create some situations in the market which are then positive for private equity investment. And interestingly, what we've looked at is, well, how have hotels performed relative to broad real estate on the equity market? So this is a chart looking at equity share price performance of a basket of UK hotel listed companies and comparing that to the UK FTSE 350 real estate index. Going back to July 2022, when this disruption in the financing markets and inflation really started to take hold. And what we can see from that presentation is that the share prices of the UK hotel basket has outperformed broader real estate by 35 percentage points over that period. So I think this talks to the ability of hotels to be able to offset and deal with the inflationary challenges relative to perhaps real estate, which has its RPI linked rent, but take longer to respond to that inflation. So we look back in terms of actually how did the hotel market react and respond after the credit crunch? We've got a chart here which sort of illustrates how broadly values recovered post 2012 and some of the phases that the market went through. First of all, we had the initial crisis phase, which everybody well experienced from 2008 onwards. But as we emerged from that, we saw an initial period of deleveraging where lots of NPL sales and more of the investors who were comfortable dealing with those complex situations, conducting those transactions, particularly, as I say, relating to the deleveraging from the banks. We then went through an asset management phase where after the assets are transferred into private equity ownership, then actually a transition into particular funds that were focused more on that kind of operational performance improvement, maybe dealing with some of those issues which had built up through the crisis. And then moving into what we've termed more of the institutional phase. So after that initial turnaround has been implemented, we're getting more into a business as usual situation, then transitioning to more institutional private equity. And then the final phase, as we felt we were running through towards the end of 2019, which is more about financial structuring. What are the different opportunities in terms of financial instruments to reduce cost of capital to ensure that with the valuations and how they've improved, you can still get the right return for the investors in those deals. So a few different phases. I think what's going to be interesting as well, as we have deals restart, what type of deals, what style of deal will they be? So what we're seeing as to where we are right now is the deal pipeline is starting to grow. There's significant dry powder to be invested. I think we've seen a subsiding of that real volatility, certainly from an operational perspective and a financing perspective, and all of that going towards making it possible to look at deals again and start to see that unlock. A couple of things I think will be important for that. First of all, I think we have still got this position of buyer and seller value expectations. And from the sell side, we've seen that impact on profitability and we've seen that impact on the cost of finance, then, views of how that impacts on value. But also I think one of the key catalysts that might see deal activity pick up is that we have got a wave of debt maturities that are coming up. And with the increased cost of finance, where profitability might be, does that create a funding gap that needs to be met that might trigger either refinancings or possibly even asset transactions themselves? So I think in terms of what's next, then I think it's important that actually the deal types will be very situation specific because of the disruption that the market has seen. But we think, thinking back to that recovery from the GFC, 3 types of deals might well come to the fore over the next 12 months or so. First of all, we do expect to see some deleveraging, not significant NPL sales as we saw out of the credit crisis, but I think some banks, some lenders may be looking to reduce overall exposure to the sector through refinancing and possibly asset sales. I think more of that asset management style deal where there's a need for capital and perhaps enhanced, more experienced operational input to deal with some of that operational disruption to recover value. And then also looking at some financial structuring style transactions where you've got a good business, but the balance sheet isn't quite right for the current levels of performance. Maybe there's a need to plug a funding gap or provide financing to bridge to that recovery or also fund growth in the business itself. So I think the catalyst might be uncertain as to what really kickstarts deal activity, but I think we've seen in previous recoveries that actually once the first deal happens, then you typically see a number of deals start to flow from that. So hopefully that's provided everybody with a bit of a backdrop in terms of what we're seeing in the market, and look forward to the rest of the discussion.
And Graham, coming back, yeah, I'm back on now. A couple of questions from the audience. Sure. Firstly, there's a question that someone notes that domestic blue collar travel is obviously increasing. Is it really true, though, in relation to white collar travel?
Yeah, certainly from the conversations we have with operators across the market, then they are seeing a return of white collar travel. Some of it is a little different. It may not quite be the frequency that it was before, but I think companies are really encouraging teams to get back together, to meet in person. We're perhaps seeing an increase in the volume of smaller meetings rather than perhaps the larger set piece events. But no, I think there is a recovery in that, and it certainly seems quite broad-based across the country, certainly from a UK perspective.
Thank you. And the next question is, which companies are included in the UK hotel basket?
Yeah, so this looks at PPHE, it looks at IHG, and it looks at Whitbread.
Great, thank you. And your outlook going forward, how do you feel? Positive? I mean, it's obviously been mixed over the last 6 months, but what do you view now?
Yeah, I think that there is, so one of the reasons why we put the comparison up to broader real estate is I think there's been a bit of a tendency to try and look at overall impacts on all real estate, all operational real estate. And I think what has struck us certainly has been the ability of hotels to offset those inflationary pressures through pricing. And there's also been a benefit in terms of some supply coming out of the industry, particularly with some of the government contracts. And all that has meant that for the industry itself, there's a greater match of supply and demand, which has given some of the pricing strength to the hotel operators.
Great. Graham, thank you very much. That was excellent. Thank you very much for your time this morning. Now can I invite Charles Human from HVS to come and join us? Charles, good morning. And I'll pass over to you.
Thank you, Chris. Morning, everyone. I think Izzy's got my slides, if they could be put up. So what I'm going to do is just take a few minutes to run through some trends in private equity investment in European hotels, both past and present, really to follow on from what Graham has said. So if you go to the first slide. So this looks back over the last 20 odd years and shows the level of private equity investment in European hotels. It wasn't really until the mid-2000s that private equity really established themselves as players. Prior to that, there had been some sort of opportunity funds and so-called vulture funds, but it wasn't really until 2004, 2005 that things really took off. And since then, average volume of investment by private equity funds in European hotels has been 2.5 billion per year. And that compares to total average annual volume of just under 14 billion. So it's about 18% of total volume, which possibly sounds low given the importance we all put on private equity funds. There have been some big highs in those years. So 2007, big year, possibly not the wisest of move given what was to come shortly afterwards. And then big investments in 2014 and 15, principally in some large portfolios that had been restructured following the GFC, and then more moderate levels of investment. Next slide. Generally, the private equity funds want scale, and they particularly like platforms. So 70% since 2000, 70% of acquisitions have been in portfolios. The average deal size has been about 120 million. And the sweet spot, so 70% of deals have been within the 45 million to 170 million range. Very little private equity investment in smaller deals. Next slide. So of total portfolio transactions since 2004, 25% have been from PE funds, and over the same time they've invested in 12% of single assets. Next slide. So this shows annual PE investment into European hotels compared to other investors. So other investors include the likes of the institutions, the REITs, the family offices, hotel investment companies and operators who are, I think it's fair to say, typically have lower cost of capital, long-term holders, compared to the PE funds who are looking more opportunistically, more short term. And what's interesting here is the divergence that really started from 2015-16, where other types of investors increased proportionally their investment hotels and lower activity, relatively speaking, from the PE funds. And what this is really showing is PE funds selling to other lower cost of capital investors, and the PE funds finding it increasingly difficult to compete against other investors who with lower cost of capital. So the likes of the listed real estate companies around town, Pandox and so forth, Covivio, AXA, some of the big longer term investors with lower cost of capital. Next slide. So over the last 5 years, 70% of PE acquisitions have come from 10 PE funds listed here, pretty much all household names. Blackstone, obviously, are the biggest of the lot. Brookfield also, very significant investments, but 70% coming from these funds. Next slide. So the PE funds have been very active sellers as well as buyers. So it's almost a mirror image here of purchases and sales, and it reflects the intended short-term nature of private equity investment. So 48 billion has cumulatively been acquired over this period, and 39 billion in sales. A slight lag effect, but so very, very, very strong on both sides of the coin. And what we've seen, I think, private equity funds will typically say that they look at buying with an intended holding period of somewhere between 3 and 5 years, and more hoping for 3 rather than 5 or even shorter. And we've seen those holding periods reduce over time. So what this chart shows is in a particular year. So if you take 2005, for instance, of the acquisitions made in that year, the average hold period has been 11 years, reducing down to 2014 of 3 years. So this shows primarily the impact of the global financial crisis, where PE funds had bought prior to that and then had to hold on to achieve their pricing targets and couldn't sell at a period of low values. And as values have recovered and the market has improved, holding periods have become shorter and shorter. But it's likely that that's now going to rise with the impact of COVID and the issues that we're facing now. So we will almost certainly see PE funds holding on for longer than originally intended. So it's interesting to see that hotels are one of 3 sectors within real estate where the allocation of PE funds has increased since pre-pandemic. So logistics is one, hotel hospitality is the other, and healthcare, and offices very marginally, but not surprisingly declines in retail, against backdrops of uncertainty in other sectors. So certainly on a relative basis, PE funds view hospitality and hotels as being areas of opportunity, both short and long term. Where have they been buying? Really long term, the UK has been a big focus, but what we've seen more recently is more focused on Mediterranean markets, resort markets. Spain has been a big focus, increasingly Italy, and those are the markets that have seen most activity over the last 5 years. UK was 2022. UK saw more activity in the market, with a couple of large portfolio acquisitions, very low levels of investment into Germany, and particularly low into France over that period. And what we've seen, and Graham touched on this, what we've seen really is since the middle of last year, when interest rates started to rise, we've seen a pretty strong slowdown in private equity investment into hotels. More challenging times, harder to leverage, which is pretty crucial to a PE fund story. More expensive cost of debt, lower levels of debt available. So since July 2022, there's been around 400 million euros of private equity investment into hotels, and that compares to 10 billion from other types of investors. So it's a fraction of investment, total investment into the market. And year to date, 2023, there's been 150 million invested compared to 3 billion from others. So only 5% of total investment into hotels. What this does show is that the market is by no means at a standstill, and that there is transaction activity, but it's not really from the PE funds. Where have they been buying more recently? It's a mix: Belgium, Spain, and various deals in Germany, France, and Sweden. Who's been active? You can see here. So Lone Star, Sonoweg, Catman, Apollo have all been active, but relatively low levels of activity generally. It's a tough time for private equity funds to make acquisitions at the moment. There's low levels of debt available. The cost of that debt is significantly higher, and that we haven't yet really seen a movement in pricing from sellers. So the private equity funds are really biding their time, waiting for either reduced values or improved debt markets. And what they have become is more active as debt players with debt funds. It's a good market to be a lender in many ways, and I think many are more focused on that side of their business rather than the equity side. We are seeing signs of sellers reducing pricing expectations to get deals across the line. The increasing debt maturities are likely to present opportunities and activity. This is a significant challenge that the market will face over the coming 12 months, and that we think will almost certainly lead to more activity, probably lower values to be expected, and more activity for the private equity funds. So I hope that's helpful. That's just a quick run through.
Charles, that was great. Thank you very much. Great presentation, really interesting. A few questions for you from the audience. Firstly, what do you believe is the reason for the little private equity investment in Germany?
I think, I mean, there was, going back 10 years or more, I think it's a number of factors. One is a lot of hotels there are leased, and that's not really a model the private equity funds follow. They want to take operating risk, so there's less opportunity from that point of view. And I think they've just found better value. It's been a very low yielding market driven by very low interest rates. It's a low yielding market with kind of relatively stable growth and better opportunities in the more unexploited markets, particularly of Southern Europe.
I mean, it's interesting to me. It's interesting how your presentation obviously mirrored Graham's in lots of ways. What's your outlook going forward? Can I ask?
What's our outlook? What's
your outlook on the future?
Yeah, I think it's going. This year is going to be quite a tough year all round. We are seeing, although inflationary pressures look like they're going to ease off, it's a pretty tough time for hotels at the moment. Top line is holding up more or less, it seems, but margins are being squeezed. Debt maturities are a big issue. So we think it's going to be a pretty tough time, to be honest. And it's hard to imagine the values are going to do anything other than decline to some extent over the next few months. So we expect to see activity pick up towards the latter part of the year, but not really in earnest until 2024 probably.
Okay, that's great. Charles, thank you very much. Now, just a favor from you, there's a number of questions on the Q&A. Could you just take a few minutes to answer them after the presentations? That would be very kind.
With pleasure.
Yeah, that'd be very nice of you. Thank you for that. Great presentation, as I said. Now, can I introduce Russell Kett, Chair of HVS London, to join us. Hello, Russell. Nice to see you.
Hi. Morning,
I'll pass over to you.
everyone, and if I can invite my colleagues on the panel to join us on screen as well, that will be great. We've got a wonderful and experienced panel of people who know everything that is to be known and will do their best to answer both my questions and yours. And I do stress the desire that we should answer questions from our distinguished audience, as you have already started putting questions in the Q&A. We'll try and answer as many of them as we can. Your questions matter more than the ones that I've prepared. So please make sure that we get the opportunity to deal with the hot buttons that you have. So a welcome to these 6 distinguished experts. And I hold their opinions in extremely high regard. So 4 come from the world of private equity: Jan Willem, Tina, Sabine, Chris. We have a lender, Louise, and a lawyer, James, to boot. So whatever we say, James will pick up the pieces afterwards and make sure we don't get sued. And hopefully we'll have a lot of interest in what you have all got to say. Now, we all saw at the very beginning of the session that there were 3 polling questions. So I'd like you all very briefly just to tell me how you would have replied to each of them. So the first one was, do you expect investment in hotels in the next 12 months to change in volume? Okay, so was it growing by 10% or more, growing by 5%, which seemed to be between the 2 of them? Everybody expects things to grow, very little remaining the same, and hardly anybody expects it to decline. So just very quickly, Louise, what's your view on that question?
10% or more.
10% or more. Chris?
Growth, 10% or more.
Jan Willem, any difference?
Yeah, no, I think it will increase 10% or more.
Nina?
Similar.
Okay, Sabine?
10% or more, same thing.
And James, you're not going to disagree with all of these wonderful people, are you?
Only slightly more pessimistic, because I think there are 2 things. Number one, it's about finding the opportunities. And as we're seeing at the moment, it's very hard for people to secure opportunities because they're just not coming to market. I guess you've got a question whether that's relative to the last 6 months, which has been very quiet as well. But yeah,
Okay.
It's going to be challenged to find deals.
Okay, and if people are going to acquire, and given what Charles and Graham have been saying, maybe not, what are they going to acquire most? Is it going to be city centre, conference, suburban, limited service, or resorts? You saw what the answer was. Tina, what's your plug?
I suppose I don't really like to pick a segment because I think it's quite dependent on market opportunities. But I suspect people will continue to be investing in good markets, so city centers with strong demand, as well as leisure resorts. But for us personally, we look much more around what is the operational plan, what is the platform growth trajectory, and what is the management team like.
Okay. Sabine?
Yeah, I can only echo actually Tina, because it's a case by case, isn't it, right? So what we like is certainly we like to go into markets where we see, kind of deep kind of liquidity in markets. I mean, we have the opinion it's really good to know at what price level you're going in, but if you want to get out, you should be able to. So you don't want to find yourself in a market that doesn't provide you for those opportunities. And other than that, certainly we do like, for a number of reasons, more the kind of urban hotels, simply because there is also always a life after, in case if something, you decide to change usage, which is obviously some of the areas that our development team are quite well reversed in. So, but we certainly agree that there's lots of opportunities for in leisure currently. And I think this has been proven as well by the statistics we saw early on from HVS as well.
Lovely. James, quick one from you.
I think it's going to be European leisure.
European leisure. Jan Willem?
Anything really where we can have some value add. So, city center, resorts, airport locations, but anything where we can, do something with CapEx, rebranding, converting management contracts into franchises, do some cost cutting. So anything value add, really.
Wonderful. Chris?
I agree with all these guys. It's gateway cities.
Everybody's in violent agreement with each other.
The one thing that I will pick up on there is, I thought it was interesting that 0 people said MICE and conference hotels.
Yeah.
And if everyone's flocking to the key things, the value is going to go up, right? And the contrarian play is to go into MICE and conference. Talking our own book slightly, but what we're seeing across our De Vere portfolio is the meetings and event space is holding up.
A lot of the kind of meetings that are happening are, people are keen to get their teams back together. They're not doing that in their offices, they're doing that offsite. There's still a lot of regulatory training. And so, again, it's just interesting to see people's perception of that market as the worst one to invest in, which creates an opportunity for people to invest in it.
Okay, so Louise, bring up the rear on this one.
Well, obviously I'm coming at it from the different angles. So for me, it's city centre hotels because they're the most stable throughout the various cycles. So yes, I accept the opportunities for private equity will be elsewhere.
Wonderful. Okay, and the final question we asked, and then I'm going to move off this. So a very quick answer. The main reason that's going to discourage investors from acquiring or investing in hotels in the next 12 months. Most people seem to feel that the availability of debt finance was going to be the main one. Concerns about rising inflation, need to invest in capex, lack of available supply, and then the geopolitical stuff and bid-ask dividend. Very, very little traction on that one. So, Louise, it's all down to you, is it? Ability of debt finance, is that going to be the biggest block?
Potentially. I mean, debt finance is there, and what we have seen is new entrants come into the financing market. Unfortunately, the debt quantums that people are used to receiving are curtailed, and there's nothing that we can do about that. It is a symptom of the increased interest costs, and assets can only accommodate so much debt. So definitely the amount of debt that you can put out on an asset is lower than what you were originally requested for.
Any of the panel want to disagree or enhance on that particular one? Chris, are you?
Well, I guess it's. I guess the biggest thing is the lack of available assets that are on the market. I guess if there, as Louise says, right, there is debt there. It's just how much, and that just goes to pricing. So it's the bid-ask spread and the availability of kit on the market that's probably the biggest factor.
Okay, Jan Willem, anything different?
No, I think that's, I'm still worried about some of the recovery, particularly in Germany. The UK seems, and even including the regional UK, but London obviously done really well, but if the region done pretty well in terms of recovery of the occupancy and the average room rate is up quite a bit. But there are some pockets where the recovery has not been that strong. So I'm still quite worried about that and how that's going to pan out. So Germany, Austria, Switzerland, some pockets in the Netherlands, some pockets in Central Europe where the occupancies are not recovered at all, close to 2019 numbers. The average room rates are also hovering 4 years later, still around the 2019 numbers, so with significant amount of inflation pressure in all of these countries. Okay.
Sabine, any view that challenges anything that's been said already?
No, I think, I agree again with what my panelists said. I do believe as well that I think the operational side to hospitality is still something that some parties are shying away from. So I think there, and simply because, as you all know, the significantly increased kind of costs that come along with labor, the ability to find labor and to retain kind of staff is obviously is not a trivial exercise. I do want to say though that some institutional investors, and we all know, I guess, some of the likes that already started to form a firmer view are starting now to come into the hospitality space. And I think this is an interesting trend to see. So these are people who are not necessarily running after value at opportunistic returns, but they're happy with core plus, and they are, capital that traditionally would have certainly not entered hospitality. So to my mind, a sign that there is a certain level of appreciation that if you get your head around the operations, this indeed is an asset class and can assist you in driving alpha big time.
Okay, Tina?
Yeah, sure. As you guys know, we've been a private equity fund that's only invested in travel and leisure for the last 3 decades. So we don't really rotate into other asset classes. And I think as opposed to shying away from operational levers, we see that as our way to have a competitive edge and to create alpha and to beat inflation pressures, right? I think the hotel sector outperformed CPI during the last high inflation period in the US in the 70s by 1.5 times more broadly and 2 times for the resort sector. That, I think that that's a really good trend and for this asset class as we enter into this high inflationary period. And that operational lever, I suppose, is where we still see opportunity, frankly, in Europe, because there's still a lot of family-owned businesses. There's still a lot of undermanaged, capitalized, and a lot of CapEx that you can spend to drive that alpha. That's where we're hopeful to find some opportunities despite some of the other market challenges.
Lovely. And last but not least, James.
Sorry, Russell, just I'm muting myself. I think it's going to be an interesting challenge around where the best place to invest is. So I agree with Tina in terms of for them, for the equity who are funding on the sector, it'll be easier for them to go forward.
Okay. So let's move to a few questions that I've prepared, and I'll start to look at what's in the Q&A and see if there's something there that we can bring out as well. But just kick us off, if you don't mind. I want one particular aspect of the hotel sector from each of you. What excites you most at the moment, Louise?
Having a full set of 12-month trading record that I can actually look back and make some assumptions against. I think after 3 years, the various different closes and disruptions, just the return to normality is exciting.
So Louise yearns for a 12-month P&L that doesn't have any excuses. Chris, what's yours? What excites you most?
I think what's getting us most excited at the moment is kind of picking up Graham's slides around where we're at in the cycle and the kind of probably the deleveraging that needs to happen, and the opportunity that creates for well-capitalized private equity, right? For a long time, we've been competing with a lot of lower cost capital. And I think now there's opportunity to really kind of differentiate and for us to kind of push up the risk curve and do some deals that other guys are a bit kind of find a bit taxing or get a bit of indigestion over, which for the last kind of 4 or 5 years or so, COVID excluded, was just, the guy that paid the highest price won.
Okay.
Tina, were you paying the highest price? What particular excites you?
But I suppose for us, where we're really excited is we've spent the past few years investing in growth platforms. And now we have a strategy either in city center Europe, in mid-scale regional UK, and boutique UK and boutique pan-Europe. And we believe that those platforms can really go after their acquisition strategy and their growth strategy, particularly as debt financing and pressures come in and hit individual owners. Those are probably assets we wouldn't acquire as a private equity fund on a standalone basis, but these platforms, these management teams are very well positioned to take advantage of those opportunities in the coming months.
Okay, yeah, Jan Willem, we've heard what's not exciting you. What is exciting you?
Anything where it's really kind of, again, going back to the value add. So where we can reposition, rebrand, anything else, and more activity coming out and more assets being put on the market, I think is really going to excite a lot of people to go back into hotel investment, because there was a lot of competition for quite cheap money for quite a long period of time. And I think also not only the refinancing is going to go and create some opportunities in people deleveraging, but also I think the redemptions with the larger institutions could also result in some more kind of hotels being put on the market.
Sabine, are you in line with that? What's particularly exciting you?
Yeah, I simply like the fact that we now seem to have arrived at a point whereby the overall outlook for the industry is actually quite positive, right? There is a sense of, things kind of ramping up again, and we already alluded as well to the point where we are in the cycle perspective. And yet at the same time, if you look at, it's true, some of the ownership of the assets, some of the leverage levels that some of these hotel owners currently are confronted with, and the resulting interest costs are just not sustainable. So I guess for us, that creates opportunity. And then also along the lines of what Jan Willem said, absolutely the value add, because there was a long time whereby people call themselves, doing value add by basically just ramping up the LTV to 75%. It was possible because, money didn't cost a lot. Now it's really, from our perspective, back to basics. And as we have the, as I mentioned, development toolkit in-house, and also the day-to-day operations of assets, so we don't have to really go out and ask anybody else to do it for us. I think we are well positioned to hopefully harvest on some of those opportunities.
Thank you. Finally, James, what is particularly exciting either you or your clients at the moment?
I think, it's a number of things. Firstly, the potential of the Far Eastern tourist return. I mean, London and Edinburgh have performed extremely well without that, and they're all coming back. I think, just touch on the interest rates, I think clearly the opportunities this year are going to arise as a result of that refinancing war and the higher interest rates. So that is going to force people to sell assets. It's going to force through some innovative funding structures as well, which for the private equity on their debt side, we're starting to see those sort of whole debt solutions coming through to address the funding shortfalls that are coming up.
Okay, and just starting with you and just looking at the other side of the coin, what aspect is causing you particular concern? Just one aspect, each of you, please. Go back to
starting with me. I think the big question, the point we touched on earlier, that bid-ask gap and how long it's going to take for it to compress, because things will only start moving again once sellers and buyers are in the same place on price, and then they're not there at the moment.
And Louise?
As the lender, it's got to be interest cost movements and our assumptions around them.
Chris?
Jan Williams' point about how long that RevPAR kind of takes to recover, or where it has recovered, how long it can hold up versus how far it's got to come back.
And Tina?
I think all the macro factors have been mentioned. So I'll say one of the things that we talk a lot about as a firm right now across our portfolio company actually is cybersecurity. And so that's we think that is something that all our portfolio companies, all the operators really need to get up to speed on as fast as possible. But frankly, it's very hard to catch up to these hackers and what's being out there in terms of attacking these systems. So that keeps us up at night more than perhaps in the macro trends that you can manage through cycle.
Good to know. Sabine?
Yeah, I believe that the areas where we have some level of control on, I think we feel a bit more comfortable, such as, operating models and kind of making sure you drive efficiencies and all the rest of it. So what keeps me up at night is indeed things that we have very little control on, which are, interest rate movements, which are indeed kind of geopolitical tensions, energy prices and the like. Having said that, the latter is apparently now coming down quite nicely, but these are, so it's the big pictures where, as I said, as a private equity player, you have very little, I guess, influence on, and yet it will have significant implications on the performance of your investment.
The problem with coming last of the group of six, Jan Willem, is that everybody else has chosen the one that you particularly wanted to mention. But what aspect is causing you particular concern at the moment?
I think the one thing is on the investment side, I'm quite worried about how we're going to find the middle ground and get a price agreed. So obviously your returns are going to be measured by how much finance you can put on it. That's gone down, and the cost of the financing. All the PE guys are all levered, and ultimately that means that your unlevered returns need to go up, or your price needs to come down. And I think we haven't met that middle ground yet, clearly, because there are willing buyers and willing sellers, except very few transactions get done. So until that happens, then it's going to be quite tough to get any transactions done.
All right. So I'm going to move on to the role of private equity in the hotel investment arena, because we've got some great expertise on the panel today. And I'm going to give you each the opportunity to answer a particular question that I've identified that I'd like you to concentrate on. So, Chris, I'm going to start with you. How can the hotel sector make the best use of PE funding?
Got it. Okay, so I think it's, well, as in how do PE buying into new opportunities, or kind of guys looking to fundraise, or
either or both?
Either. Well,
but don't take a long time over answering.
Cool. Well, so I guess there's, as Charles mentioned earlier, a lot of our businesses have been growing the credit side of their businesses. So as Blackstone, Apollo, KSL do it as well, right? Actually providing senior loans and mezz financing to existing platform businesses. That's definitely an area that Louise will see, increased competition in, right, versus your traditional lending sources. And then on the acquisition side, it's the same themes we've been talking about. It's really where we're focused is the value add. Taking something that's got either a broken balance sheet or broken operations, and then using our balance sheet and our expertise to reposition that asset. That's really the focus.
Okay. And Louise, how much interference should a funder have on a hotel's day-to-day operations?
Well, ideally none. I mean, we're financing specialists in what they do. They should know more than us about the business that they're operating. Obviously, unfortunately, there are times where we have to sit together and buy into a turnaround plan. We've definitely seen that a lot over the last 3 years. But the relationship should be strong enough that we are buying into a valid business plan that a specialist has put together.
Okay. Now, Tina, you've said that you concentrate only on hotels, so you don't have experience of other sectors to draw on, but maybe Sabine can answer the question as to what your experience of other sectors can bring to the table to improve what PE can bring to the hotel sector.
Sure, I think so. From our side, having a spike, I guess, in hospitality, but also having invested, developed, and operated other asset classes such as retail or commercial and resi helps us to look at an asset for what it is, which is a brick and mortar in a certain location. And sometimes you just need to be able to say, maybe we want to, increase the room count, but maybe sometimes the answer is, guess what, guys, we probably decrease the room count, or we take out the conference facilities, or we add a different usage downstairs, or do we think about rented residencies? What else can we do in a parking lot? So I think by having, again, the ability to look at an opportunity, not just through the eyes of a hotel investor, but generally as a real estate investor, and that allows us to really identify what's the best use of this, as I said, brick and mortar in that location. Can I give you specific examples? No, because it really afterwards is a case by case, but I think that itself already, I hope at least, allows for us to maximize returns. And as I mentioned as well, that's why we do like urban locations quite a bit, because it always allows to have, or to solve, if we wanted to, for different usages as well.
Just one point of clarification. We don't do office or commercial real estate, but we're a private equity fund that does broader travel and leisure, right? So we'll do fitness, we'll do membership businesses, golf and country clubs, and ski resorts. And I do think that those operational best practices and toolkits and trends have a lot of interesting corollaries with the hotel sector, and we try to make sure that all the management teams have that knowledge base and best practice sharing.
Wonderful. Jan Willem, how can private equity add the most value to the hotel sector?
I think they're really, buying undervalued, under capex stock and optimizing some of the operating structures, particularly converting management contracts into franchise, which seems to be a trend. Franchise seems to be the way to go. So there's a lot of stuff to be done there. I think that seemed to be, branding clearly is another option.
Okay, and I'll open to you guys, but James, you can have first dibs. What aspects of hotel funding do you think that private equity is mostly going to focus on in the coming 12 months or so? Are we going to be focused on the traditional existing hotels? Is it going to be providing junior or mezz debt? And how does that compare with the equity side? Are you only looking at branded? Will you look at independent leases versus freeholds and so forth? And what are you not going to focus on? Are you going to focus on everything other than new development, for example? So, James, from your experience as to what your clients are looking at, where do you think that answer is?
Yeah, I guess if you look at it in a rising market, which we've had up until summer last year, it was quite easy to make investments. Yes, you could do value add, but you could make your returns by virtue in some ways of the prices rising. I think the suspicion must be over the next 2 to 3 years, that's going to be very hard to achieve. So I think for investors, be it private equity or anything else, it's about how do I take an asset and add value. I think one of the things we haven't talked about, and quite interesting, and Tina, I know you invest in one of them, is things like apart hotels, service department, hotel and co-living, those kind of sectors that are a bit new and a bit different. I think where people may say, well, that's where the opportunity is to take something totally different, roll it out and do something different with it, rather than traditionally investing in city centre Hiltons and Marriott's, and where you've got a much more defined asset. I think people are going to have to be inventive as to how they get the returns of their IRR target returns on capital.
Wonderful. Tina?
It's a good question. I'd say in terms of the cap stack, first you're gonna we're already seeing in the US at least our debt funds being quite active. I think when you're kind of in this part of the cycle, the dislocation first comes for the credit funds and alternative lenders, and so they're quite active. We're excited about that opportunity. Certainly from the equity perspective, we're very much on the lookout for when the values do come in line with our expectations of where the macro is.
Jan Willem?
I think clearly focus on existing hotels rather than new builds. I think they will not be very active, preferably portfolios versus single asset. But you know, they're also starting to do, the PE funds are also starting to do aggregation games. They've done that in many other sectors. So I think we're going to see a few of those where they start buying smaller assets and start to put portfolios together. Obviously, mass financing because of the lack of debt or the top of the debt. Freeholds versus lease portfolios, in my mind, I can't see them being very active buying, you know, lease opcos basically. New development, I think, will be limited.
Okay, Sabine?
Yeah, I mean, again, pretty much echo here what we heard so far. I think the opportunity, certainly there's a lot of talk about the debt side, and I think that rightly so, again, given that obviously senior lenders are being, I guess, restricted to some level from ICR covenants and the like. I think that probably creates quite significant opportunity across the board, by the way, not just for hospitality. I do think that there is a value to be found for, you know, converting independent hotels into internationally branded ones, as we already had before. And then, you know, I think depending on the market, I mean, there can be obviously value in you know, taking leasehold assets and trying to convert them back into freehold. I think for us, you know, we are agnostic, but obviously the clear preference for investors normally would be the freehold title, right, eventually. So I think from that perspective, yeah, that's kind of the, I guess, the focus of classical private equity.
Russell, the only thing we haven't really mentioned here, which is kind of interesting, is the kind of the debt of the office. And I wonder if PE on the long term are going to start to be interested to start to convert offices into, let's say, budget hotels. I mean, that's not been
we did that
so far, but it wouldn't surprise me if there's going to be some PE guys out there who are going to do conversions.
So we did convert
one. Going to tell us that she's done it. But go ahead.
Yeah, well, just to say, we did convert one. The only issue with that is obviously it works actually reasonably well with, let's say, some older, smaller size B stock offices, right? That obviously are facing considerable kind of valuation issues currently, you know, also from an ESG perspective. The only issue with that is sometimes, you know, if the floor plate is too big, too large, the issue is as a practical one, because your room will only have a certain length. And so as a result of that, if the floor plate is too large, and obviously you need to have as well, you know, windows or natural light, you can't just, you know, build your room like, you know, 2 meters times, you know, 10. It just has to have a certain minimum kind of width as well. And, you know, short of just putting a hole into the heart of that building in the middle, which is obviously highly inefficient. For the bigger offices, I'm not sure how well these conversions, you know, kind of will materialize. But yeah, you're right. So we did it on a smaller size B office, and it actually works quite well.
And of course, if you've got larger floor plates, that gives opportunities to the hostel sector, who can make just bigger rooms and use those dead spaces in the middle of buildings.
That's right.
Yeah, the conversion math still needs to work though, right, to Sabine's point, because some of these offices aren't located where that traveler would go, or the valuation of price per square foot for those commercial offices for some of them might not work from a conversion story. But I agree, it's there, it's just, it's not this everything can be converted into hotels and it solves the problem of office space.
Yeah, I mean, actually I have a theory about retail. You know, we know the way the retail sector is going. If you've got these big department stores, leave the middle of the floor plate to retail and take the outside of the buildings where the windows are, and put hotel rooms around it. But anyway, that's for another time. Chris Penny.
And well, just picking up what the guys have said, it is definitely going to be the trend, right? I think new build development is super expensive with what's happened with labour inflation. So repurposing existing buildings is much more cost effective. And the same thing of moving from independents to brands. It's really interesting talking to Marriott, Hilton, IHG. They're all pushing their soft refurbishment brands. So that, you know, really trying to get that refurbishment cost down and plug it into their distribution system. I think a lot of independent owners kind of got through COVID with various government supports, taking out extra CBILS, extra loans, etc. And now those guys are coming up for a refinancing, and there's the opportunity to plug it into, you know, something like a Marriott as an Autograph or IHG as a Voco or whatever, right? And yeah, that's going to be, you know, I think a few more assets going in that direction.
Thank you. So, Louise, it's interesting that none of our private equity players seems to want to get into providing mezzanine finance or junior debt or whatever, sort of leaving the road free to the traditional lenders. But what's your view on what most people are going to want to be seeing investment in? Do you, for example, get involved in development finance for those that have the courage and the will to want to build from scratch?
Yeah, we're still doing development finance. I think the pipeline of development projects is much smaller, but there are, you know, still plenty of investors that it's costly to not do anything with their sites. And development finance is achievable. It is higher priced at the moment because it does come with a higher risk. We have to be clear that it is, at the current times, the inflationary pressures, it is higher risk. But I think it's taken a step back and understanding the projects in detail, specifically their procurement plans, which parts should we be able to lock down costs on, which parts should we be adding more inflationary assumptions to. So I don't think that development will stop. Potentially, it's more high net worth investors where they can hold their projects for a longer term than it is private equity at the current time. And I think that is key, that in order to really maximise your investment, the holding horizons are longer.
Okay, I'm going to
maybe I can just add one thing. I think Chris and I both work for firms that have credit funds, and that team, I think, are really excited about the junior piece you're talking about, because frankly, senior lenders, their LTV is lower than what the actual ask is out there for total proceeds. So I think about, if anything, that's where we're seeing the most activity and opportunity in the US is our credit team.
Interesting.
Yeah, exactly. It's just the return hurdle for the opportunity fund, right?
Yeah.
Okay. Thanks, guys. I'm going to look to our distinguished audience to ask the next question. First of all, follow up on the rising cost of capital, both equity and debt. Would you consider club deals and having multiple investors on board to lower that cost? What are the pros and cons of something like that further down the line? So, club deals, any interest, Jan Willem?
I've not really seen that, I think, but in the past, I think, you know, all the PAs, they don't really need any other capital. I guess mixing it up with lower capital requirements on funds, I think is going to be difficult.
And Tina?
We've done club deals and larger deals. It doesn't solve for cost of capital issue, because most of the time we're partnering with another private equity fund like KKR that has the same cost capital as us. But we did it on Apple Leisure Group as well as on our Ross Aviation, which is our private aviation business in the US. And that was more of a question of bringing complementary skill sets and also capital to the table for a large deal. But it doesn't really, as I say, solve the cost of capital issue.
And for you, Sabine, are you involved in any or interested in him?
I mean, certainly in theory you can, but then, you know, practically you look at issues like, again, the mandate we normally have is we're not passive, right? We're active. So you're becoming part of a club, and then, you know, who's control, you know, it's not impossible. And certainly, you know, we do, but generally speaking, it's not a club. It's more, you know, co-investments alongside of, for example, what we do, right? So that's more what we're used to see actually.
I
Chris?
think, Russell, I can see your club with the seller. Sometimes the seller stayed in.
Right.
So
Seller financing could help, right, in this day and age, the debt financing issues. We've seen that in terms of being creative on capital structure.
Exactly. I think, as Graham pointed out in his presentation, like there's no shortage of dry powder. It's only if it's a really large deal. So we teamed up with Blackstone in 2020 when we took down ESA in the US, but that was a $6 billion transaction. So
can you just stress the B of billion rather than the
billion? Yeah, exactly right. And then we've done another $1+ billion of bolt-ons on top of that. So mega deal in the US, that sort of thing. We team up, but I think most of the guys on this call will have the capital to do the deals if they can get the returns to work, right?
Okay. James, any examples of club deals that you've been involved with?
Yeah, so I mean, we've got a number of deals. I mean, Tina said it. Doing it where the equity is clubbing together is difficult, but bringing in skill sets, we see that quite a lot. Whereas a capital investor who hasn't necessarily got the skills to manage and run a hotel will team up to do that together, and they may put some capital in as well. Vendors staying in the deal, and that sort of thing tends to be far more common than sort of JV type structures between private equity, unless it's a very big deal.
I'm assuming, Louise, you have nothing to add on this, but if you do, now's the time.
No.
Another member of our distinguished audience says, to what extent does ESG drive your investment decisions? He points out that typical investment memorandas are remarkably silent on such matters. So, what do you see as the role and importance of ESG on the hotel sector, Chris?
So it's definitely an important factor, right? It's becoming increasingly so. Over the last probably 4 years, it's gone from something that we talked about at the back end of our investment committee papers to something that's right at, up front in our analysis. The risk of obsolescence in assets is, something that a year, 2 years ago, no one was concerned about. People just used to get an EPC. And as long as it wasn't an F or something, okay, we're fine. Now we're much more focused on, is this asset, the whole UK, European and global economy is moving towards net zero at various speeds, and you're going to have to align into that. I think where actually we see the biggest focus on this is not just on the investment side, but on the operations, and actually using that to drive your returns by improving energy efficiency, decreasing the cost, but also I'll talk my own company here, but working with a company like One Hotels and the way that they position those assets on the sustainability point really taps into customer demand, and you can drive a real rate premium because the customer wants to travel sustainably, wants to go to a hotel that aligns with their beliefs and values, and will pay up for that. So it factors into our whole underwrite, but also operationally how we're running our businesses, managing our waste and our energy consumption, and it's flowing through into profitability.
Sabine, I know you're pretty passionate about ESG. So what do you have to say on the subject? How important going forward?
And you're right. So we've been obviously on this kind of road already for quite a while. So as people know, we had the first ESG manager 8 years back, and simply because again, if you are the developer and if you are the day-to-day operator, you want to make sure that you're doing things right. In particular, ground up development initially, and then also now on the reconversions of assets as we're going along. I mean, we heard it before, it helps on so many areas, right? I mean, it helps on the energy side, energy bills obviously going up. So that's great if you have a way of how to mitigate that, at least to some level. It helps you from your, financing as well. I mean, at the moment, everybody talks about green loans and the fact that the conditions may not be, from a commercial perspective, so much superior to the standard commercial loans. But fast forward in 5 years' time, we do believe that, as risk management is starting to rule our lives, right? It's going to be, you are ESG compliant, you get a loan, you're not ESG compliant, so you will no longer be compliant for senior banking. And I think that means that the cost of finance is going to go up. We see it in, when it comes to staffing and retaining your staff, and that the next generation, they do take those things serious. So important element there. And then, in some areas, you even get, benefits from the government side in the forms of taxes. I mean, one of our bigger platforms is obviously in Australasia, and there the government gives you a final withholding tax kind of break if your asset happens to be, achieving a high ESG standard. So it makes sense already today commercially, plus you're doing the right thing by the environment. And, fact is that in Europe, some of the biggest institutions will no longer be able to invest because they're obviously from a, I guess, EU taxonomy perspective, if your overall portfolio doesn't hold a certain percentage of ESG compliant assets, not just in hotels, but again, in general, going forward, you'll be fined. So it's a pretty obvious, from our perspective, it's a pretty obvious thing what people should do. Now, obviously, the big question is, how are we getting there? And as I think 80% of the buildings that will be standing in 2050 already are standing assets. It's really up to us all to figure out ways of how to make those standing assets, and convert them into ESG compliant ones. That's certainly a task upon us all, and it's not easy, but we just have to work on it.
So it's not easy, Tina, or have you found a way to make it easy?
No, it's not easy, and certainly the measurement and trying to keep up with exactly what the regulatory government is going to want out of a report from a reporting perspective. There's a lot of catching up to do, even if you are doing all the right things to get up to speed on the reporting element. I'd say that I would only add, I agree with everyone in what they said. The only thing I'd add is it's also becoming incredibly important to the employees of our hotel companies. There's certain companies that we have today that I think actually are better positioned from a labor market perspective because they align very well to the values of their employees. And so it's not just the consumers are demanding it, but it's also our employees.
So consumers are demanding it, employees are demanding it, investors are demanding it. Jan-Willem, how do you make it all stack up?
Well, I think, ESG becoming obviously a major item in all the investors' mindset now. I think there's still a lot of confusion and some lack of clarity about, what the different metrics are, the requirements. But I think that obviously over the next couple of years, that will be very much clarified and everybody's really focused on it. And ESG reporting is becoming now quite normal in all institutional reporting, both to the banks and to the investors. I think there's still a risk as well on this zombie properties. We're going to fall behind, and it will be so expensive to improve and hit these requirements over the next couple of years.
Interesting. Now, Louise, you're looking at it from a different perspective, but is this now more than just a box ticking exercise as far as you're concerned?
Yes, I think so. I mean, part of our appetite is financing well capex assets, or where the project is to provide capex on those assets. So I think with that in mind, it's quite hard for investors to be doing capex without thinking of energy efficiencies and everything else that's going around it. So I think the nature of the business we do means that ESG is important to those transactions. Measuring on an ongoing basis is an issue. I think it will be interesting when it's all brought into the uniform system of accounts to see what type of asset is performing at what level and what looks good over the variety of assets that we finance. It's very easy for a purpose-built limited service asset to be performing at one level, but try putting that on a luxury asset and something that's been repositioned, they look very different. So I think the monitoring is going to be, needs to be thought through.
Interestingly, I was having a conversation yesterday evening with a member of the committee that is responsible for producing the next edition of the uniform system. And I asked her, to what extent are you considering ESG as part of this? And even they are now finally waking up to the fact that this does need to be properly addressed. And I'm hopeful that by the time, I think it's the 15th edition, it's the next one coming out, by the time we get that, ESG will actually have made more of an impact in that. James, I'm going to ask you to wrap up on this particular topic. And do you have a good example of a hotel company that's already dealing with ESG particularly well?
Yes, well, we have one on the call, but there are a number of people out there who are sort of leading the charge on that. So Lamington and Zeal Hotels, again, you talk to them, they are very much into that as a key part of their business strategy going forward. I guess there's a couple of things. You look at other real estate sectors, there has already been government intervention saying you have to hit minimum energy criteria standards. I suspect we will see more and more legislation, and it's almost certainly an impact on hotels. They've done offices, they've done residential letting. It is coming our way. The government will be saying you have to hit these standards. What there hasn't been, and this has been a discussion we've had lots of times, is I've done a number of green loans. The reality is the pool of capital funding those is no different from the capital funding and non-green loans. What we haven't seen yet in any great volume is capital allocations that are specifically targeted at green assets, and that I think is what will come. It's not there yet, it's not in significant numbers yet anyway, but when there is a real distinction between the funds specifically targeting that sector with pricing that is beneficial to do so, that's when we'll be starting to get that.
Okay. A very quick follow-up question to build on what we've been talking about comes from our audience. How much do the panel believe the significant cost of hotels heading towards net zero will affect their valuation aspirations? How much do the panel believe the significant cost of hotels heading towards net zero is going to affect your valuation aspirations? Jan Willem, a very quick answer from each of you.
Well, valuations will be impacted by the additional capex you need to spend. So,
So values are going to go down. Anybody got a different view? Okay.
All I'd add is that I don't think hotels are any worse than any average business anywhere globally, right? So the value of everything will have to go down because we've got to decarbonize the world, right?
You've got to find the money from somewhere. Okay, guys, I'm very sorry, but we've got to our last question. Our time has run out so quickly. A very quick answer from each of you, and please don't repeat anything that one of the other panel has mentioned. But I would like to know, in your view, the key trend that you're factoring into your view of the hotel sector over the next 12 months. What key trend are you factoring in, Louise?
Probably, unfortunately, interest costs staying higher for longer than what we anticipate.
Chris?
The return of travel into Europe.
Sabine?
How things are paneling out between people looking for leisure destinations or leisure travel, and obviously seeing the, business travel coming back, whichever shape or form.
For me, I think it's owners having to find cash to inject into deals on refinancing and potentially see the stress sales when those don't come through.
Jan Willem?
Higher cost of renovation and capex.
And Tina?
Cost of airfare for travel, or just the cost of travel outside of hotel stays.
And with that, I bring the session to an end and thank you all very much for your participation. Thank you all very much. Chris?
Thank you very much, Russell. That was great. Really interesting discussion. So thank you to all panelists. That was very good. Thank you. And thank you to all the presenters this morning. Two great and insightful presentations from Graham and Charles, who explained the challenges the industry are facing now. I see my screen's gone pink, so not quite sure why, but it adds a bit of flavour. Do we agree that we face a challenging rest of 2023? I suspect that is true, and are we looking at recovery now in 2024? Question mark. Fascinating panel led by Russell. Look, hotel assets have performed relatively well over the last few years, and that's been encouraging. There is clearly an opportunity, and despite all the challenges, and investors are clearly looking for those opportunities. ESG does seem to be becoming a bigger and bigger issue, so that'll be interesting to see how that becomes and grows in time. However, where is the best place to invest? Which countries will attract the best investment as we move forward? I think there's clear indications from our speakers, but do you agree? Overall, you do get a feeling there's a real sense of positivity spreading in the industry, which is growing. I think everyone is very nervous about Q1. I think people are glad that Q1 performed as it did, and we are seeing a stronger recovery than perhaps was expected. And overall, the outlook is more positive than perhaps people feared back at the start of the year. Thank you for your questions today. That's obviously a key part. Thank you for your engagement. And thank you to all. And I look forward to, I wish you all a good day and wish you well for the rest of the time. Thank you very much indeed.